Well, hi traders, and welcome to Big Themes for 2024, the outlook for the US dollar. Now, I think this subject's really important because if you can generally get your US dollar call correct, then you're going to do well in most of your asset allocation. Now, we've got to that point in proceedings where sell-side economists and strategists have been given their currency calls for G10 and emerging market currencies for Q1, Q2, Q3 and Q4 of 2024. Now, strategists are generally loath to make these calls. They're required to do so because it needs to feed into other models such as equity valuations to try and look at your expected returns, which of course is so important in the investment world. But of course, if any of the assumptions that go into your model prove to be incorrect, such as GDP or consumption or inflation, then the whole thing becomes unwound. And certainly if you see a big move in the spot price that goes against you, typically you tend to move your price closer to the market. So for traders, where these calls are, offer us absolutely no value whatsoever. In fact, for a lot of people, they can create emotional biases and attachment to the market, which we need to separate. Where I think traders can get some benefit from these calls is understanding the thesis behind why they've made these calls, the direction, what gets it to that point. And I think from that perspective, it can help you manage your risk in a somewhat more efficient fashion, what to look out for. And I think it can help you, loosely with your position sizing going forward. All that's obviously going to be dictated to more by the volatility in the market. Now, we are coming into the close of the year. We're going through December. And we know that December is typically a poor month for the US dollar. We've seen it, the dollar index down 6 months of December in a row now. Dollar CNH is typically one of the big drivers of that, and that has a big negative performance through this. And we can see the dollar index at this point is pretty flat for the year, with the trade-weighted US dollar index up about 1%. Now, probably one of the big themes that we've been fielding this year is this understanding about carry and whether it can continue going into 2024, understanding that central banks will continue to cut rates. And I think probably the big standout point for me in FX markets in 2024 is the performance of LATAM currencies on a total return basis. Now, if you told me at the beginning of the year that the Colombian peso would have been up 38% year to date, with the Mexican peso and Brazilian real having very, very strong gains as well, despite the Federal Reserve raising the Fed funds rate to 5.33%, US real rates on 10s up at 2.5%, and these LATAM central banks starting an easing cycle, then I would have been certainly very much in disbelief. But the total returns, you've seen there have been staggering. And the question is with a rate cutting cycle now emerging in developed markets, probably from mid-year, will we see carry performing remarkably well going forward? Now, if we have a look at consensus in the market for the US dollar in 2024, we can see that the consensus broadly is for a weaker US dollar. You can have a look at the consensus or the median calls at the moment from sell-side analysts, and you can see that for Q1, euro dollar is expected to be at 108, Q2 109, Q3 110 and 111 by the end of the year. So euro dollar expected to have a slow grind going forward. And the dollar index expected to get to about 97.7 on that by Q4, which gives you about 5% downside in the broad US dollar there. You can have a look at cable, and while expectations are that we are seeing some short-term downside in the pound, by the end of the year, the market's expecting, or the medium consensus, that gravitates to about 126, the Aussie dollar to about 70 cents by quick Q4, and also dollar yen, which I think being short dollar yen seems to be a broad consensus trade at this moment. Now, I think there's a number of factors behind this call, and I think first of all is the idea that if you look at where starting points at the moment in economics, the US has had an exceptional year. Trading US exceptionalism has been one of the big themes supporting the US dollar for much of this year. And the starting point at the moment is, if obviously we've seen a blockbuster Q3 where quarter on quarter growth is closer towards 5%. Year on year in Q3 was about 2.9%. Now that is peak growth, and we should meander down to the point where we get to about 0.5% or so by Q3, which is kind of where we're peaking those lows. With the US growth numbers trajectory falling lower and below trend, the market's expecting the unemployment rate to pick up to about 4.5%. But there are some calls that we could see that unemployment rate move up to about 5%. And with that cooling of the labour market, the consensus is that we're going to see non-farm payrolls numbers, which are averaging over 200,000 at the moment, slowly grind out through the quarters to get to about 30,000 on average by Q3. And there are some economists who are expecting net job losses to come through in that situation. Of course, this is exactly what the Federal Reserve want to see, a cooling of the labour market, a steady grind up in the unemployment rate, and growth to cool to below potential, which causes that situation. If we also have then a look at what's happening in core PCE, you can see that the consensus is expecting a move through 3% into Q2, into Q3. It doesn't hit the target of 2%, but it's not too far off, and it's the trajectory which the market has. In that situation, it will allow the Federal Reserve to make these so-called adjustment rate cuts. The idea that they don't need to have such a restrictive policy, they can bring it down to a more neutral setting because the labour market's cooling, because they've got strong conviction that inflation's moving to trend and growth is obviously very cool in that situation. And with that, we can see a situation where the US dollar, in theory, should weaken off. Now, we can also look at it on a top-down perspective and have a look at the general consensus that we are going to see positive asset returns in equity markets. The general consensus is that we'll move closer towards 5,000 on the S&P. We're going to see tight credit spreads and fairly low volatility. And in that backdrop, typically that's a headwind for the US dollar, and we see growth currencies and pro-beta, high beta currencies doing well in that situation. So from a top-down perspective, we can see why that's causing. And then we also have to look at the challenges, where if the US dollar is going to go down, where does that capital go to? Now, obviously in Europe, we've got very, very low growth, but that starting point is obviously very much discounted into the price of the euro at the moment, the exchange rates. If you have a look at consensus for European growth, it is expected to gradually pick up. So we are at a trough in the market size or the consensus size, and we should see better times ahead. As US growth is coming down, we're going to see a situation where the rest of the world growth is picking up, and that right-hand side of the US dollar smile will come into its own. UK growth, very similar situation, where UK growth is bottoming out and may actually trickle up a little bit longer term. And I think the market's a little bit bearish on UK growth going forward. If we have a look at China, China's been very much under the spotlight because of its property markets and its efforts to try and ring fence property sales and contagion effect, should we say, in the developers markets as well, and trying to stem off what we've been seeing there. And China could accelerate going forward and come to about 5% GDP growth in 2024. We'll have to see how that steps up. So the consensus, as you know here, is that we're going to see good asset value returns, which will be a headwind for the US dollar. With the Fed starting a rate cutting cycle in that situation, and we see growth mean reverting, that the US dollar should come under pressure. Where I think we need to have an open mind and, of course, challenge this thesis, because 12 months obviously is a very long time in these markets, is the idea that, if we are going to see a significant downdraft in the US dollar, where does this capital go to? We need a challenger. Is it going to come from China? Maybe not. Is it going to come from Europe, the UK? Is it going to come from emerging markets? That's the situation. If the US dollar is going to come under pressure and we see good capital outflows to the US, where is that capital going to go to going forward? We also need to have a look at the potential for a recession. As you've seen from economics, the consensus is that we see a soft landing, and that's firmly in the price at the moment. But if we were to see a recession, and that is going to be one of the big themes for 2024, will we not? Will we see a recession? If we see that situation, then I think the US dollar has a strong rally. Even if the Federal Reserve are cutting, there's a good chance that if we would see that, then we would see big drawdown coming through in the S&P. The VIX would trade above 25 into 30%, and the US dollar would work as a safe haven currency, even if the Federal Reserve are easing. And I think in that situation, currencies like the Australian dollar, the Kiwi, high beta currencies in emerging markets would come under pressure, and certainly carry would reverse. So we need to understand the propensity or the possibility for a recession. That's going to be one of the things that really changes those forecasts for the US dollar going forward. Of course, we've got the presidential elections coming through in November. We start proceedings in January, the primaries in Iowa, and we're going to be getting a good sense through that period into Super Tuesday as to who is going to be the Republican and the Democrat nominee. And I think if you look at some of the policies that Trump's looking at, which includes a blanket 10% import tax, that could be very US dollar positive in itself. So we might see the US dollar having a strong rally into those presidential elections, depending on whether Trump is the nomination, which looks very much like to be the case, and also how he's polling in that situation as well. We also need to obviously have a look at what's happening in China, where we see concerns around its property sector manifest into outflows continuing in China. That doesn't seem to be the consensus at the moment, but obviously it's something we need to watch. And the other factor is what's happening in relative balance sheets. There has been a strong correlation between the dollar and changes that we've been seeing in the Federal Reserve and ECB's balance sheet. And it looks like the way that things are going, that the Federal Reserve balance sheet is going to normalise at a far faster pace than what we're seeing from other central central banks, including the ECB as well. So an interesting one. I think you have a look at the consensus for dollar weakness. That may be blown out of the water, but the thesis is quite interesting in the idea of mean reversion and relative economic trends. We'll see how that goes throughout the year.